Hello, good day. This video focuses on basis and basis risk for futures contracts. The content may overlap with my earlier videos on forward, futures pricing and hedging. If you do not have the foundation knowledge about futures, I would encourage you to watch my introductory video on forward and futures. When large investments are involved, basis risk can have a significant effect on eventual profits or losses. Even a modest change in the basis can make the difference between gaining a profit or suffering a loss. The inherently imperfect correlation between spot and future prices means there is a potential for both asset gains and asset losses. At the end of this video, it is hoped that students will be able to understand the concept of basis and the sources of basis risk. With this understanding, students can predict the impact of basis risk on a hedger's position. Let's learn together. Let's reiterate what we have learned about spot prices and future prices so far. We have learned about the definition of both prices. The spot price of an underlying is the prevailing cash price in the market. The futures price represents the market opinion of the spot price on some future dates. We have also learned about how futures prices are related to spot price. Futures prices reflect the price of the underlying assets. How is the relationship between future prices and spot prices? While future prices are highly correlated with the prices of the underlying asset during the life of the futures contract, that correlation is not perfect until delivery. We shall learn further. Next, we are going to learn a concept known as basis. What is a basis? The difference between the futures price and the spot price of an underlying at any given time is called the basis. Basis is equal to the price of futures contract minus the spot price. Let's have a quick quiz. If the spot price is the same as the futures price, basis is equal to? What is your answer? The answer is 0. Basis reflects the carrying cost. What is carrying cost? Carrying costs are the cost of holding inventory in stock. For example, insurance, storage costs, warehouse, employee costs, depreciation, cost of replacing perishable items, opportunity costs, and cost of capital. So far, we have learned how to calculate the fair futures price using the following formula. Recall that basis reflects the cost of carry, and basis is the difference between futures price and spot price. When we rearrange the first formula, we shall obtain the formula for basis. This equation is also known as the theoretical or carry basis. Basis will be positive if the cost of carry is positive and negative otherwise. The actual basis, also known as gross basis, can be divided into two types: theoretical basis and value basis. Theoretical basis represents the carrying cost. Value basis is the difference between the actual futures price and the fair futures price. The value basis measures the degree of under or overvaluation of the actual futures price. Let me ask you a question. Which is higher, spot price or futures price? Well, both situations can happen in the real world. If the futures price exceeds the spot price, the basis is positive. This situation is known as contango. The futures price tends to fall over time towards the spot price, equaling the spot price on the delivery date, at which time the basis is zero. On the other hand, if the futures price is less than the spot price, the basis is negative. This situation is known as backwardation. The futures price tends to rise over time towards the spot price, equaling the spot price on the delivery date. So, again, the basis is zero at delivery. Next, I hope you can understand how arbitrage activities happen in the futures market to bring the futures price equal to the spot price on the delivery date. Speculators will always buy low and sell high to make a profit. If the futures price is higher than the spot price, as in the case of Contango, speculators will sell the overvalued futures contract and buy the undervalued cash market goods at the same time in order to make arbitrage profit. On the other hand, if the futures price is lower than the spot price, as in the case of backwardation, speculators will buy the undervalued futures contract and sell the overvalued cash market goods at the same time in order to make arbitrage profits. Hedgers will take positions on the futures contract depending whether they are long or short the underlying cash market goods. Hedgers act based on their expectation about the spot price. What is basis risk? Basis risk is the risk that the futures price might not move in normal, steady correlation with the price of the underlying assets. Basis risk also means offsetting investment in a hedging strategy will not experience price changes in entirely opposite directions from each other. The fluctuation in the basis makes hedges less effective than they are meant to be. Recall that the purpose of hedging is to minimize exposure to potential loss. However, basis risk can cause potential excess gains or losses, thus adding risk to the position. Between contract initiation and liquidation, the price spread or difference between the futures price and the spot price may either narrow or widen. If the basis remains constant until the trader closes out both of his positions, then he will have successfully hedged his market position. If the basis has changed significantly, then he will likely experience extra profits or increased losses. Recall that basis is the difference between futures price and spot price of the underlying asset. Therefore, basis can be calculated from the following equation. Note that prior to expiration, the basis may be positive or negative. Let's try an example on how to calculate the basis. The basis is 1550 minus 1500 and the answer is equal to 50. In this case, the basis risk is the risk that between now and maturity of the contract in 6 months, the price of gold will fluctuate by more than or less than 50. In general, the sources of basis risk can be classified into 4 types. Let's learn one by one. First, basis risk can be caused by imperfect matching between the cash asset and the hedged asset. This type of basis risk is also known as product or quality basis risk. It arises when a contract of one product or quality is used to hedge another product or quality. This means the qualities of the asset are different from that of the asset as represented by the futures contract. Offsetting vehicles are generally similar in structure to the investments being hedged, but they are still different enough to cause concern. For example, jet fuel is hedged with crude oil because these contracts are far more liquid than derivatives on jet fuel itself. Companies making these trades are generally well aware of the product basis risk, but willingly accept the risk instead of not hedging at all. Another example is to hedge against a 2-year bond with the purchase of Treasury bill futures. There is a risk that the Treasury bill and the bond will not fluctuate identically. Second, basis risk can be due to changes in the component of the cost of carry. Recall that basis reflects the cost of carry. For example, change in interest rate, storage costs, safekeeping, and insurance. Third, the sources of basis risk include maturity mismatch, which is also known as calendar basis risk. In this case, the selling date of the spot market position may be different from the expiry date of a futures market contract. The hedger may be uncertain as to the exact dates when the asset will be bought or sold. The hedge may require the futures contract to be closed out before its delivery month. For example, hedging an exposure to physical prices in May with a June futures contract. Although this discrepancy may only be for a short period of time, the basis risk still exists. Lastly, basis risk can be caused by location mismatch. Location mismatch is the risk that arises when the underlying asset is in a different location from where the futures contract is traded. Location mismatch is commonly seen in the commodities markets when a contract does not have the same delivery point between buyer and seller. For example, hedging crude oil sold in New York with crude oil futures traded on a Mumbai futures exchange. What is the impact of basis risk? As general guidelines, when the market is in contango, that is, futures price higher than spot price, the short hedger would benefit if the basis narrows and loss if the basis widens. The opposite is true for the long hedger. The long hedger would benefit if the basis widens and loss if the basis narrows. When the market is in backwardation, that means futures price lower than spot price, the short hedger would benefit if the basis widens and loss if the basis narrows. The opposite is true for the long hedger. The long hedger would benefit if the basis narrows and loss if the basis widens. We are going to look into an example about the impact of basis risk. Suppose a rice farmer is worried about price decrease and wants to hedge against possible price fluctuation in the market. On the other hand, a manufacturer is worried about price increase. The current spot price of rice is $50 and futures price is $55. Both parties enter into a futures contract. The farmer takes a short position and the manufacturer takes a long position. Assume futures market is in contango. That is, futures price is higher than spot price. The original basis is $5. 2 months later, the spot price and futures price change, and we assume 3 scenarios. The basis could narrow, remain constant, or widen. The original basis is $5. We assume the scenarios when basis decreases to $2, remains constant at $5, or increases to $8. This table shows the net gain or loss of the short hedger and the long hedger. When the market is in contango, the short hedger would benefit if the basis narrows and loss if the basis widens. The opposite is true for the long hedger. Before I end this presentation, let's have a quick quiz. Read this statement about investment assets and consumption commodities. Which one has a lower basis risk? Why? I'm sure you can derive the answer from the slide. Happy trying! Finally, we have come to the end of this video. I hope you have learned some knowledge from this video. If you like this video, please click like, share or subscribe to my YouTube channel. Thank you, see you and goodbye.